before diving into the main topic of the webinar, I wanted to bring into context the transactions environment just prior to the outbreak. As you can see, 2019 was the highest year for sales on record in our region. We recorded close to $14 billion of hotel sales, and that represented around a 60% growth in the prior year. The APAC trend was actually in quite a bit of a strong contrast to EMEA, where Brexit uncertainty led to flatlining of volume. And in the Americas, we actually saw a decline as late cycle activity slowed down, and there were also less portfolio sales. Go to the next slide. Looking into the region in a little bit more detail, essentially last year we saw record volumes in pretty much all the markets, with liquidity led by Japan, Singapore, and China. There were a number of large one-off single asset sales that really helped drive a lot of that activity. Examples of these included the Westin Tokyo, the Andaz in Singapore for $350 million, the Grand Hyatt Seoul for over $400 million, and two key sales in the Maldives that traded for just over $350 million. Now, Thailand was a bit of an outlier in that. Overall volume was down last year, and this was in part due to sales moderating after record transactions in 2017 and 18, including several in Bangkok. And also because a number of trades that were expected to close in 2019 spilled over into 2020. So at the regional level, we saw demand that was fueled across all buyer categories as record levels of investment were made in Asia Pacific. And private equity was really the dominant capital, followed by high net worth buyers. And we finished 2019 not only with record sales, but also strong investor sentiment and an overall positive tourism outlook for the region. But unfortunately, the music stopped there. Now, our original forecast for 2020 was $10 billion of sales for Asia Pacific. This would have represented, I would say, a respectable amount against historical averages and shown a moderation as we came off a record 2019, with the possibility that some economic and political headwinds could have influenced how investors underwrite their investments, specifically around cap rate movements and market expectations going forward. However, against the COVID backdrop, in the year-to-date May, we've seen volumes fall by more than 60% to 1.8 billion. And based on current pace, we expect 2020 to finish at around $4 billion. This would represent around a decline of 60% against our original forecast and a year-on-year decline of more than 70% against the prior year peak. It's also on par with 2008 and 2009, when we saw 3.6 to 3.9 billion of sales following the global financial crisis. So let's talk about the industry house view. What's the lie of the land now? And I think it's fair to say we're still in very much the eye of the storm, but this is what we're currently seeing. As borders are shut and both domestic and inbound demand are heavily impacted, I think it's no surprise that double-digit RevPAR declines across the region are the norm and continue to present a real challenge to recovery. Based on early signs, it's clear that domestic demand and drive to destinations will lead the resurgence. But the markets that had a supply and demand imbalance and which were already feeling the pressure prior to COVID will feel a sharper impact and a quicker buildup of stress. And there was a question earlier in the Q&A about distress, and this is exactly where we anticipate some of that distress to come from. The silver lining, I think, is that the supply pipeline will decline as some projects are put on hold and some are considered for alternative use. And I think this is going to give some much needed breathing space to owners. From a pricing perspective, there is at the moment very little market evidence. And I would say that buyers and sellers are very much in a discovery phase. I think it's safe to say that there is generally right now a bit of a disconnect with owners holding out on values to the extent that they can, whilst buyers are on the lookout for deep correction. For now, owners are very focused on disciplined cash flow management. And in Bangkok, of course, this includes tapping into government subsidies where available, for instance, for wage support, and in particular, reliance on the strength of existing banking relationships to procure much needed working capital injections and moratoriums on payments. Now, overall, the recovery scenario looks a lot more prolonged than our original anticipation of a swift V-shaped recovery. Generally, we expect the road ahead to look likely to take anywhere between 12 to 36 months from when green shoots of recovery take place. And we think green shoots will happen towards the end of this year. And that's going to really depend on each market's characteristics. So taking into consideration the domestic base for Bangkok, we believe the recovery in Bangkok will take around 18 months, and not to the 2019 peak, as Jesper mentioned, but to a realistic and sustainable level of profitability. And in the ensuing time period, private equity does see a cyclical opportunity to invest into the sector at attractive prices at the start of a new cycle. Similarly, high net worth buyers are anticipating the same, and they're holding on to significant cash reserves. Now, both buyer categories are not active just yet, but they are proactively monitoring, and they will be ready to put some of that dry powder to use soon. So I think in closing, what does this all mean for values in Bangkok? To start with, I want to caveat by saying that the analysis that we've done is mathematical in nature. So please do not boo the messenger. What we have done is to conduct a Monte Carlo simulation where we looked at the potential path of cash flow recovery post-COVID and possible movements in cap rates based on real-time investor feedback and by referencing cap rate movements during prior crises. We then ran the simulation 10,000 times, resulting in possible value declines, illustrated through a probability distribution. Now, I would stress that this is only a forecasting tool, providing a view on a range of potential outcomes, but it does not take into consideration specific asset qualities, as well as emotive or strategic investment needs of buyers, nor the level of stress in a vendor, all of which could influence the final outcome between a willing seller and a willing buyer. That said, assuming a recovery was to take place no less than 12 months and cap rates move by 50 basis points, the correction in pricing relative to 2019 would be by 10 to 15%. If the recovery was to take longer, say 18 months, and with a cap rate expansion of 75 bips, pricing movement could be in the order of 20%. And for Bangkok, some 60% of the total value change is due to the cap rate movement. And 40%, I would say, is due to lower profit earnings in the initial years of recovery. I think ultimately Bangkok tends to feature very heavily on investors' radar, and the low levels of historic liquidity in the market do help create a bit of a pent-up level of demand that have compressed cap rates and elevated prices. So with the right strategic opportunity coming to the market, it's arguable that a willing buyer could be prepared to accept lower initial yields. And we saw this in some instances following prior demand shocks in Thailand. And therefore, it's possible that the proportion of the value correction could well be mitigated. Thanks for listening, and I hope that was helpful. I'd be happy to answer any questions later on.